Okay. Leslie, don't go anywhere. I want you to be part of this conversation as well, because we want to bring in Kate Kelly as well from the New York Times. She's been covering Goldman Sachs for a very, very long time. Of course, they were the lead underwriter of what has now turned out to be a bit of a flop, at least on day one. Kate, what do you think happened and what went wrong?
Well, I think Leslie hit on some key points here. We had an unusual type of debut with a larger than usual retail mix and some key components that allowed people to flip their shares earlier than typical. So, for example, employees of Robinhood were allowed to sell their shares day one if they wanted to, rather than having the traditional 6-month lockup. Then you had this small investor component, which I believe ended up being 20 to 25% of the stock, even though they had set aside 35%, by the way. So that in itself, the fact that the 35% wasn't used could be regarded, pending a few more details, as a little bit of a bearish signal from the get-go. But you may have had a good deal of flipping activity in addition to your kind of standard hedge fund flipping activity. Of course, the goal with most IPOs is to find those long-only holders, those sticky holders who are going to provide you this strong investor base and see you through at least your initial growth cycle, not sell the shares on day one. But obviously, there was a lot of activity there yesterday. I checked to see what the short interest was, but it sounds like we may not be able to get those details for a little while yet. But clearly, there were a lot of bearish signals. So I think the technical process played a role. But I also think there are clearly fundamental questions about Robinhood as a business model and whether the growth they saw during that first quarter, even as they faced a lot of headwinds with the GameStop and meme stock frenzy, can last. And the herd on the street in the Wall Street Journal did a good job of this today, kind of talking about some of the issues. But I think there are real questions. Are they going public at the top, or are they well on their way to a strong and fast growth trajectory? And it's just a hiccup along the way.
Leslie, weigh in on this piece of it, though, which is that when you hire a bank like a Goldman Sachs to underwrite an offering, they're supposed to advise you on price. Now, in this case, they obviously wanted to get as much cash as they could, given that this is a business that actually wants and needs cash. But was there any debate, do we know, internally about the price? Was Robinhood the one pushing on the $38? Was there ever a conversation about bringing the price even lower and what that might do?
I did ask sources about this, and of course, people who were in the room all were a little bit cagey about those discussions, saying that, it was a mutually agreed upon price. Everybody was happy with that $38 a share. What's kind of interesting about this deal as opposed to others is that usually the lead left bank that's in charge of allocating the shares is also the stabilization agent. Stabilization agent is what we were kind of talking about earlier, is someone who could come in, help prop up the stock if it does seem to be losing its footing on day one. In this particular case, those two roles were divided. Goldman Sachs was lead left. They were in charge of allocation of more shares. JP Morgan, on the other hand, they were stabilization agents. So you had kind of two banks doing the job that typically involves one. Not sure that made a huge difference, but interesting just as we kind of talking about the differences of this IPO process nonetheless. Another thing that, in talking to investors yesterday, usually we start to hear throughout the course of, the week leading up to a big IPO like this, we'll hear about, so-called it's oversubscribed by X amount of times. Those numbers don't always mean anything because they're just based on unbinding indications of interest, but it's still an interesting data point. It's something that people tend to talk about. With this one, we just kept hearing it was covered at the IPO range. That too is not the best signal to send investors because they're kind of waiting for those oversubscription numbers. As fluffy as they may be, they do provide some comfort to people.
Shepard Smith here. Thanks for watching CNBC on YouTube.